Welcome to FXpert Trading, where I use time cycles, median lines, and other technical analysis to identify trade setups in the US stock markets as well as the FX markets. If you like the information contained within this video, be sure to subscribe for more. This is the futures chart, and as expected, we have topped on this orange cycle and potentially put in the trough for the beginning of the next orange cycle. We do still have time to put in a later trough this week, but for now it appears as if the trough may have occurred considering the bounce we did get after continuing the sell-off initially after the CPI report. I've moved to the SPX daily chart. I know there is a lot on this chart. I just want to quickly review the points at which I began to enter short trades with the expectation of a low coming in March, likely in mid-March, using the upper warning line of this median line. This is a modified shift median line dating all the way back to October, the October low, and then the February of last year peak and the trough from last March. And you can follow this warning line up and you can see it's previously provided resistance and we were returning to it. I know I have other median lines on here. For the moment, let's just ignore those. So each time we butted our heads against this, I entered a quarter here, a quarter here, a quarter of a position, another quarter of a position here, and then the final quarter was on the open on Monday. And then sure enough, we sold off on Tuesday after the CPI report. Those shorts, as I mentioned in the prior video, have a longer term expiration and they are spreads. I'm not ready to go heavy short yet because we continue to make higher lows and higher highs. And I was expecting this to come in. If we go back to the futures chart for a moment, Wednesday would be a perfectly ideal cycle to be the average amount of time. It can come in early, it can come in late. That's why it can still come in later this week. There are many different ways that we identify when these troughs are confirmed. I've gone over those in prior videos. I'm not going to do that in this video, but I am going to show why I entered a short-term long at the open on Tuesday. To do that, I'm going to go over to the SPY chart. You can also see the median line that I had identified in the last video. This is a very long-term median line. Acted as perfect resistance when we reached it on Monday. And then, of course, we sold off for CPI. That doesn't mean we can't come back up and break through it. But if we do break above this, I think it's just going to be a temporary overthrow before we finally do correct. So why did I take a long on Tuesday when the market was selling off hard? I'm going to go to the hourly chart, not only because we were expecting a trough to come in sometime around ideally Tuesday, Wednesday, or Thursday, but we gapped down right to this buying channel support. I showed this in the last video. It's acted as support not once, but twice. We did actually ultimately sell off through this, but it is possible we reclaim it and or just back test it later in the week, at which point I'll be looking to close out that long. It's a spread. I got it on the SPX. It has a Friday expiration, so I'm going to be looking to close that by Thursday. Considering we did sell off through this and actually closed below it, it is possible that the trough will come later and this is going to be a loss. That is very possible. But I was willing to take that risk because of the expected trough where we gapped down to, which had been prior support, and because the short positions are essentially a hedge for this long. Well, really, it's kind of the other way around. The long is a hedge for a short position, for the short positions, because I'm expecting this to go much further down. The short positions, I got an average of $120 on a 5-wide spread through all of the entries that I made, which means I have the potential to make over 3-to-1 on those should those work out. In the short term, if we should bounce higher, and those become less likely to be profitable, the short-term hedge would help reduce the overall loss on that trade. Ideally, I'll be able to make something on the short-term bounce and the longer-term puts. Again, considering where we gapped down to on the CPI news, I took an aggressive entry. I did not wait for confirmation of the trough, in part because I'm expecting a short-term bounce. Here would be either to go for an aggressive entry or for no long at all. This is a different SPX chart. We're on the daily time frame, and as you can see, I've gone over this one in other videos. I have some different trend lines here, and another reason why I was willing to take a bit of an aggressive entry on this particular short-term long trade was because we gapped down near to, we ultimately did end up bouncing off of this trend line that we broke through. This is actually a clone of the orange trend line from here to here, cloned up here. We had broken above it, and we are back testing that now as support, from which I do expect we should get at least a short-term bounce. If we do break through it, as I anticipate we will sell off further in the future. But considering the multiple levels of support that we were at or near and the short-term expected trough, I felt that it was acceptable to take a riskier than normal entry on a short-term long position. That said, going back to the futures chart, considering where we are within this blue cycle, which is roughly 2 months, we should definitely start looking for short positions. In addition to those longer term short positions that I have, I will probably put on some more longer term expiration trades to the short side. But how can we find some more aggressive entries with a shorter time frame in mind? There are a couple of ways, some of which I've talked about in other videos. Going to the 3-hour chart, turning on the 8 FLD, as you can see, we broke clearly below it on this move down. Well, after we get a cross above, which is one way we can confirm this trough, if we break down and close below in a clear, decisive fashion early in this orange cycle, considering the longer term cycle that we believe to now be bearish, or at least should be turning bearish, we can make some more aggressive entries to the short side. Another way we can do that is using these daily cycle troughs, and as soon as we break below a prior daily cycle trough, we can assume that the orange cycle has turned bearish, and we should be expecting bearish momentum not only through the orange cycle, but then also through the remainder of the blue cycle. Finally, considering the position of the cycles, there's another very good, simple way to determine when would be a good time to start to put on more aggressive entries to the downside. We're on the SPX daily chart. We're going to look at some historical cycles. I'm going to show them to you first and see if you can figure out what changes within the cycle from when we have the bullish momentum to the bearish momentum. This was a very strong cycle here, so we're not going to go over that. We'll start with this one. This is the trough. What changes from here to this candle? It's not the color, and the peak actually comes a candle later. But had you gone short here, this could have been a successful short trade into the trough. Now, this was the first cycle in a longer term cycle, so you expect bullish momentum. You would not actually short this, but we want to see what changed. How can we figure out the momentum shift? This is another perfect example of it. Here's the trough. Momentum is up, and it's this candle right here that would tell you you can go short. Actually, pretty much right at the open of this candle, you would know you could short for the rest of the cycle. Let's go look at, so this is strong bullish momentum here, so this is a little more difficult. And then this is in a downtrend, so we want to kind of avoid that because we're not officially in a downtrend yet. So we want to look at similar situations and similar types of cycles to see how we can find something that will tell us, some piece of information that will tell us when we can go short. Let's look at this cycle right here. Here's the trough. We have these candles moving up. It's this candle right here. So it's not the color. What is it about all of these that tell us we can go short? All we do is we break below the prior day's low. So let's look at these cycles again. We put a low. The low of the following day is higher. The low of the following day is higher. higher low, higher low, higher low. This candle right here broke below the prior day's low. That's your signal to go short. If we look at the next cycle, this was a bullish cycle. You didn't get the signal until the trough was coming in. This is the same fractal I've been comparing the current cycle to for some time now. This was not CPI, this was the FOMC, but it was a similar type of news event which confirmed the peak. And we may be doing that right now. But let's take a look. Here is the trough. It's actually this candle right here. Even though the next few candles continued, well, to stay within this range, but had higher closes than this particular close, had you gone short here for the remainder of the cycle, you would have been just fine. If we look at these cycles, it's the same thing. Daily higher low, daily higher low, higher low, higher low, higher low. We take out the prior day's low, and that would have been a great time to go short. We see the same thing here. Even though this one took out the low here, would have been a very small shorting opportunity. You could have, since we just took it out, could have entered again on this candle since you would have been getting a better price. But this particular cycle was the beginning of a new cycle. You're not going to short that. Even in these more bullish cycles, it's the same thing. When would you go short? When we break below the prior day's low. But again, this was a generally bullish cycle. This late into the cycle, you don't want to go short. That's why this particular cycle, I was also not going short in the short term. But assuming this trough is in, or if it comes very soon within the next few days and we start to push higher, all we need to wait for is a break below the prior day's low. And that is a good indication that the orange cycle is turning bearish. And if it has not made a new high above this high, it is very likely the blue cycle peak is in, and we are just going to be moving down for the remainder of the blue cycle, which is about mid-March. We are now on the VIX. I have time cycles down here. The time cycles are generally not very reliable on the VIX. This one happened to be perfect, pretty much, but I don't make any trades based off that or anything like that. However, we do have a trend line which we just bounced off of, which this I believe was the day before the peak. Yes, it was the day before the peak. And then ultimately on the CPI sell-off, we broke through this trend line here. I have two, you'll see, they are parallel. This first one has been resistance at many different points. We've broken through it many different times. And then we have a second one up here where we like to wick up to. And in this case, we wicked up to it exactly. And I did not move this. I realized I could move this higher. This is just where I happen to have it because it has a lot of different touches. It does spike through, but it has more touches in this particular spot. And we happen to touch it on the nose today. If you wanted to be more aggressive towards the downside, you could wait for a retest of this other trend line. Or if we make it to it, a retest of this trend line with the anticipation that the VIX is going to spike again, which will signal a top potentially forming. And that is another consideration for a potential short-term short trade. Finally, I'm going to touch on Apple. I have not done any analysis of Apple on this channel before, but Apple is weak compared to the S&P overall. It is underperforming names like Microsoft, Meta, Google, and it just presented an excellent opportunity to go short. I actually opened a put on Monday at the open for a couple of reasons. One, in this blue cycle, we've actually already taken out the cycle low, which would suggest the entire blue cycle should close below the open. It is possible this turns into a mixed cycle and this come back up, but it's more likely that this low on the blue cycle will be somewhere below the open of the cycle. Additionally, we have a couple of different median lines which Apple appears to be respecting. So we have a standard median line set, peak, trough, peak. That's this yellow. We just respected the upper warning line, from which I added another standard median line set, peak, trough, peak, which we just respected the upper warning line of. So on Monday, I opened a put. It was a small position because of CPI. In the event we gapped up or it was bought up back up to this upper warning line, I wanted to have some juice left to add to the short. I got 185 puts for 290. They were pretty cheap. And the target is where these median lines intersect, which is at 170. I'll of course also be using time to determine when to take them off. But if they reach 172, that's probably where I'll take them off. Finally, we're back on the SPX chart. I want to talk about what I will do in the event we do continue higher. I am expecting a bounce from here. I don't know how high that will go. And again, I will be looking to go short should we start to take out daily lows after we do get a clear bounce. If we do get a clear bounce before we take out any daily lows, I will again add longer term shorts should we return to this upper warning line. Should we return to this sliding parallel and this median line. And then I have one more which I did not talk about in the last video, which is a sliding parallel. It's just this median line cloned, put to the top of this peak over here, which I covered this in the prior video. You don't want to give this too much consideration, but it is something to keep an eye on. And should we achieve that line there, I'll add another piece. So those are my three targets, not targets, but three areas where I will add another third of a position on each spot for longer term shorts. As always, thank you for watching this video, and be sure to subscribe for more.